Joining me now at the IPMI Conference is Jonathan Butler. He's the precious metal strategist for Mitsubishi Corporation. He's also a speaker here in Orlando, Florida at the IPMI. Jonathan, thank you so much for being with us.
Thanks very much for having me.
So Jonathan, let's talk about the PGMs here. Obviously, we're seeing gold and silver really trade sideways and have a sideways story for quite some time. PGMs have a different story, more of a positive note. How do you see platinum and palladium set up right now?
Well, platinum's been interesting because we saw some initial buying activity early in the year. I think that was largely on the back of speculative interest, given the very high likelihood of strikes. Of course, since the strikes happened, we've seen platinum higher and lower, but at the moment it's actually around the same level as it was back in January when the strike began. And this is somewhat surprising to us. We would expect, given that 1 million ounces of mined production have been lost to date, there should have been more support for the price than there has been.
So, Jonathan, why do you think that is?
Well, I think there's a couple of reasons. First of all, the producers saw this coming. This was not a surprise. They had been preparing for this for a long time. They had refined inventories, which they were able to draw upon. We estimate around 700,000 ounces, or maybe 20% of total South African supply was available to be drawn down as refined inventories. That's happened now. That's largely been sold to the market. So we believe that the market will start acting much more fundamentally in that the output from South Africa will reflect what's being mined at the moment. So we do believe that there's potential for supplies to fall this year quite significantly.
What could that do to the price, do you think?
Well, on a fundamental level, one would expect that would give some support to the price. But what we've got to remember also is that the demand side is maybe not that strong this year so far. We have a number of longer-term drivers in the form of tighter emissions control out of Europe, which is going to help platinum demand. But we're not necessarily seeing that physical demand in the market at the moment. Sponge is more or less flat to ingot, which suggests that industrial users are not necessarily coming into the market at these levels. So I think the combination of refined inventories, which the producers held, expectation management for the industrial users, and also the fact that there's a bit of fatigue amongst investors amongst this whole strike story, even though we've seen these very high losses to date.
Now, Jonathan, before I let you go, I know we spoke about the PGMs. How do you see gold set up?
Well, again, as you mentioned, gold's been pretty range-bound for most of this year. We've had a couple of, if you like, black swan events. We've had the crisis in Ukraine, which has helped some safe haven buying for gold. The last couple of weeks, of course, we've seen some important news out of the US, a healthy jobs report. This suggests that continuing economic improvement is going on in the US. That's probably going to mean that that tapering of QE is going to be wound up by the end of this year. That's going to weigh on gold. That means the attention of investors turns to what happens next. When will interest rates rise? And our basic assumption is that sometime in the middle part of next year, we'll start to see the first interest rate rises. Of course, that's going to increase the opportunity cost of holding gold as an investment, and in general, it's not necessarily going to be positive for gold. Over in Europe, of course, the ECB unveiled its bazooka of measures last week. That had a quite surprising effect on gold. Gold actually rallied a little bit in the wake of that. But I think once the market digests this and the euro, as it inevitably will, weakens against the dollar, that's going to put pressure on gold prices in dollars. There may be some safe haven buying of gold in euros in that time, but overall we believe that the effect is going to be to weaken gold. So we're not overly positive for gold for the remainder of this year. We think it could test the lows that we saw back in December last year and even further back in June last year. But we believe that 1180 level will hold, and there's potential upside for gold later on.
And I guess we'll be closely monitoring Draghi's moves, but do you find that's the sentiment that you've been hearing from your colleagues here at the IPMI, that they feel that the way gold is trading right now will stay like this towards the rest of the year?
Yeah, I think there's a feeling that gold is going to remain fairly range-bound. Of course, there is potential upside from a deterioration in the geopolitical situation, whether that's in Russia or in the Middle East. But overall, I think the direction is pretty clear that it's not that positive for the remainder of this year.
All right, Jonathan, thank you so much. I'll let you get back to your conference.
Thank you very much indeed.
And thank you for watching our coverage of the IPMI here in Orlando, Florida. We'll have more for you in the meantime. You can email us any comments or questions at newsfeedback@kitco.com. Thanks for watching.